Housing market crash in 2023. 2023 is just a few weeks away. We are soon approaching a new year and are just about to turn the corner on the year 2023. That is why now is the best time to make predictions on the status of the real estate market in 2023. Many homeowners, potential sellers, and potential buyers are worried about the upcoming year due to the fact that mortgage rates have been climbing higher, home sales have slowed down, and in some regions, home prices have decreased. Additionally, increased uncertainty has been felt throughout the market. Experts in the sector predict that there will be less housing demand in 2023, which will most likely result in housing prices declining, as unfavorable economic conditions continue to afflict the United States. Americans are concerned about the possibility of a housing market crash occurring in 2023. The effects of a market collapse, often known as the bursting of a housing bubble, include a general slowdown in economic activity as well as unrest. Because of this, it is challenging for Americans to find their dream homes. Hello once again, everybody. If this is your first time here, let me say hello and welcome to Finance Bureau, your go-to handbook for all things crypto and finance related. I'm glad you could make it. This video will talk about the looming housing market crash in 2023. So before we get into the nitty-gritty of this whole fiasco, give this video a thumbs up, sit right back, and let's dive right in, shall we? From a historical perspective, the majority of economic downturns in the United States occur following a period in which the Federal Reserve raises interest rates. When the Federal Reserve raises interest rates in an effort to bring inflation under control, it starts to induce a contraction in the economic activity. Of course, the Fed-induced recessions often begin in the housing market, as is common knowledge. Some are predicting negative year-over-year U.S. home price declines in 2023. Some don't go so far, expecting home price appreciation to still stay at least slightly positive. A number of cities around the United States have seen a decrease in demand for residential real estate, which has led to home prices falling over the latter part of 2022. According to the findings of a prominent Wall Street analyst, prices may continue to drop by up to 20% throughout the next year as a result of rising mortgage rates and the normalization of the housing market in the aftermath of the pandemic. As of October 24, the typical interest rate for a 30-year fixed mortgage is 7.04%. Not only that, but the current inflation rate of 8.2% is quite alarming. According to the National Association of Realtors, sales of previously owned houses declined by 1.5% in September from August to a seasonally adjusted annual rate of 4.71 million units. This indicates that existing homes are selling at the slowest pace seen in the last 10 years. The analysis provides evidence that you are not the only one who is anticipating a crash in the housing market or a reduction in home prices that will make it possible for you to purchase the house of your dreams at a price you can comfortably afford. In September, the annual rate of sales for single-family homes dropped to 4.22 million on a seasonally adjusted basis, which is a pace that is 0.9% slower than the 4.26 million homes that were sold in August. According to information provided by the National Association of Realtors, the sales of single-family homes in the most recent month were much lower than they were in September 2021 by a stunning 23%. This indicates that a greater number of potential buyers are holding off on making a purchase. They are probably waiting for interest rates to drop from their current level of 7.8%, which is the highest level in the last 20 years. Alternatively, they may be waiting for a bust in the housing market, similar to the one that occurred in 2008 when the mortgage crisis occurred. After years of a red-hot market, 2023 may be the year that the housing market finally cools off, which is a big word, especially when you're talking about real estate. However, looking at the current economic conditions and recent financial uncertainty, plus rising mortgage interest rates, it's easy to wonder whether the housing market will crash, since most people had the same concern on the state of the housing market in 2022. There will be a number of shifts in the market, the most notable of which are the leveling out of interest rates and the gradual but steady decline in the values of homes. The fact that baby boomers are staying in their homes while millennials are looking to join the housing market will keep inventory at a low level. All of this is based on the opinions of market analysts, who forecast that while the market won't crash, it will experience a course correction in 2023. During a significant portion of the years 2020 and 2021, there was a strong demand for houses, but a limited supply. The interest rate was at a record low point in history. When taken together, these factors contributed to the development of a seller's market that was very competitive. Buyers flocked to new listings, made cash bids, and raced to outbid one another. At this time, prices are somewhat high but seems to be stabilizing. Borrowing rates are rapidly increasing, and there is less and less competition. The National Association of Realtors reported a reduction in house sales in July and August, indicating a fall in demand that many attributed to increasing mortgage interest rates. However, is each of these factors enough to cause a collision? In spite of the fact that these factors may have caused some people to worry whether or not these signals another housing crisis similar to the one that occurred in 2008 is coming, the answer is no, at least not yet. However, there is more going on here than simply the current conditions. This is true of almost everything. It is essential that one considers the events that have transpired over the last several years, particularly when it comes to the pandemic, in order to get an understanding of the range of forecasts for a probable crash in the near future. Looking back, before the pandemic, the housing market seemed to be doing rather well for itself. After the pandemic and the subsequent lockdowns, individuals had a sense of being confined and were aware of their need for greater space. Many city inhabitants left the city in search of bigger houses in the suburbs, and ultimately, other people moved into their old places, taking advantage of the unexpectedly reduced rentals that were available as a result of the long duration that many properties spent sitting on the rental market. The end result of this is that the market in New York City and other regions with high costs of living is suddenly very competitive, and both interest rates and overall costs are high. However, parallel developments are taking place in other areas of the country as well. In these areas, there was a lack of available homes for sale, while at the same time, there was a significant increase in the number of people looking to buy homes. Because of the contrast between high-demand regions where prices are still relatively high and low-demand regions where prices are already dropping further, it seems that a widespread market crash is unlikely to take place. Will mortgage rates continue to climb? Since interest rates have almost doubled from their lows in the beginning of 2022, it is a safe assumption that the cost of financing a house will not be decreasing this year. This prediction is based on the fact that the interest rates have roughly doubled. But what about the whole of the year 2023? Is there going to be a brighter day at the end of this gloomy tunnel? Some say no. Continued inflation, overall higher interest rates, a potential recession, and geopolitical tensions will force 30-year and 15-year mortgage rates to go up throughout 2023 and will bring the two rates closer together as short-term risks rise, warns Denis Cherchikov, a strategist at Awning.com and a professor of economics and finance at City University of New York. He forecasts that the 30-year and 15-year benchmark mortgage loans will average 8.75% and 8.25% respectively. Robert Johnson, a professor of finance at Creighton University's Heider College of Business, shares some of those sentiments. By the end of 2023, financial market participants expect that the Fed will have increased the target Fed funds rate by 175 to 200 basis points from current levels. That would translate into 30-year and 15-year mortgage rates at roughly 8.50 and 7.70%, he says. The outlook is brighter, according to Rick Sharga, Executive Vice President of Market Intelligence at Atom Data Solutions, which examines data pertaining to real estate and property. In the beginning of 2023, he hypothesizes that interest rates will reach their highest point of approximately 8% and 7.25% for 30-year and 15-year loans, respectively. He goes on to say that these rates will gradually come down over the course of the year, somewhat to hang in the range of 6% and 5.25% respectively. This is wholly contingent on the Federal Reserve's capability of bringing inflation inflation under control and easing up on the aggressive rate rises that it has been implementing. There are three different roads for interest rates. Nadia Evangelou, senior economist and director of real estate research for the National Association of Realtors, predicts that three distinct rate scenarios will play out over the course of the next year. In scenario number 1, inflation continues to remain high, forcing the Fed to raise interest rates repeatedly. That means mortgage rates will keep climbing, possibly near 8.5%. In scenario number 2, the Consumer Price Index responds more to the Fed's rate hikes, and there is a gradual deceleration of inflation, causing mortgage rates to stabilize near 7% to 7.5% for 2023. In scenario number 3, the Fed raises rates repeatedly to curb inflation, and the economy falls into a recession. This could cause rates to likely drop to 5%, she explains. So what's next? It appears that the most significant obstacle that the housing sector will face in 2023 will be high home prices, together with difficulties in meeting the requirements to qualify for mortgages. Inflation will almost certainly warrant an increase in the interest rates from the Federal Reserve in the event that it continues to move upward. Additionally, this will result in an increase in the rates charged for mortgages. In the event that this takes place, together with the occurrence of additional risk factors such as a lack of inventory, the housing market can experience a crash. Regardless of whether the market collapses, there will be significant changes in the following year. Chris Masiello, CEO of Better Homes and Gardens Real Estate, the Masiello Group thinks that lower adjustable rate mortgages in the 3.75 to 5% range will encourage buyers to return to the market. Unlike fixed rate mortgages, adjustable rate mortgages or ARMs fluctuate with the market. However, it is generally cheaper to start with an ARM than a fixed rate mortgage. Many people feel that fixed rate mortgage interest rates will eventually level out. Most economists believe that interest rates will level out and maybe fall modestly next year. However, this year has shown us all that any rate projection is only accurate until the next inflation report. The Fed has been increasing interest rates in the hope that they would reduce inflation, and although they have had a moderating effect so far, it remains to be seen if inflation is properly controlled. In no way, shape, or form is the market anything like where it was in 2008. However, it cannot be denied that the housing market is due for a price correction. Don't lose your cool under any circumstances. Conditions such as decreased demand, an extended period of time on the market, and increased interest rates are not always the worst case scenario. I don't see much of a problem there when people stop selling and buying and trading up and instead just sort of bunker down with the mortgage rates they've got until the market is less volatile. The opportunities in the market won't come easily, but if you plan it out, it will be worth it. What do you think? I'd be grateful for any comments or suggestions you might have. Do you have any recommendations of your own? Feel free to share your thoughts and discuss in the comments section below. But always remember to be nice to each other and respect the opinions of others. If you enjoyed this video and want to see more content on finance and cryptocurrencies, don't forget to subscribe to my channel and press the like button. On the next video, I hope to see you then. Thank you for watching.